Most people think a savings account is just a place to park money. The truth is, the wrong account quietly loses money every year due to inflation. In 2026, high-interest savings accounts are no longer just a safety net. They can actively grow your money while keeping it safe. Today, we'll compare and rank the top options so you can make every dollar work smarter. If your money has been sitting in a standard account, earning next to nothing, you're losing ground. Even a difference of 1 or 2% in interest can translate to hundreds or thousands of dollars over a few years. That's why understanding high-interest savings accounts has never been more critical. High-interest savings accounts may sound boring, but the landscape has changed dramatically. Between traditional banks, online banks, credit unions, fintech accounts, and hybrid options, the variety is overwhelming. By the end of this video, you'll know which account suits your goals best, whether that's building an emergency fund, saving for a big purchase, or simply maximizing passive income. Before we rank them, let's clarify how these accounts are evaluated. Interest rate is important, of course, but it's not the only factor. We also consider fees, minimum balances, flexibility, and safety. An account that pays slightly more but imposes heavy fees can end up underperforming even a modest yield account. Safety is crucial. All accounts discussed are FDIC or NCUA insured. This means even if a bank fails, your money is protected, up to $250,000 per depositor, per bank. You want growth, but never at the expense of security. Let's start with number 5 on the list. Traditional big bank high-interest savings accounts. Traditional banks still dominate much of the market, thanks to brand trust and convenience. Banks like Chase, Wells Fargo, and Bank of America now offer high-interest savings accounts, but their rates often fall short compared to online alternatives. They typically offer APYs ranging from 0.5% to 2%, which sounds decent but barely beats inflation in most years. So why choose a traditional bank at all? Branches, easy linking to checking accounts, and in-person service are significant advantages for many. You can speak to a representative, handle complex banking issues, and access additional services like loans or credit cards seamlessly. The downside is clear: low interest and extra requirements. Many banks require a high minimum balance to earn the advertised APY or a linked checking account. Fail to meet these, and your rate drops dramatically. So, traditional banks may work if convenience matters more than growth, but they're far from ideal if maximizing interest is your goal. Next, number 4. Credit union high-yield savings accounts. Credit unions are member-owned, not-for-profit institutions. That structure often allows them to offer higher interest rates, lower fees, and more personalized service than big banks. Interest rates at credit unions in 2026 can reach up to 3.5% for high-yield accounts, depending on membership and balance. For example, $10,000 deposit earning 3.5% APY grows to about $10,350 in 1 year, compared to just $10,100 at a big bank offering 1% APY. Over 5 years, the difference becomes significant. Over $1,200 more just from choosing the right account. Credit unions may require membership based on location, occupation, or other criteria. Digital features, while improving, sometimes lag behind online banks. But if you qualify, a credit union is a strong option, especially if you prioritize community and service. Number 3. Online bank high-interest savings accounts. Online banks dominate in 2026 because they don't carry the overhead of physical branches. They pass these savings directly to you in the form of higher interest rates, often between 3% and 5% APY. Online banks usually have no monthly fees and low or zero minimum balances. Most offer intuitive apps, easy transfers, and even automatic savings features. For example, depositing $20,000 in a 4% APY online bank account could earn you $800 in interest in 1 year, completely risk-free. Over 5 years, assuming compounding, that grows to over $4,300. The only downside is the lack of physical branches. If you prefer in-person service or need complex banking products, online banks may not be ideal. But for straightforward savings growth, they're often the best choice for most people. Number 2. Fintech cash accounts. Fintech companies are transforming banking with high-tech solutions. Accounts like these combine savings features with easy-to-use apps, instant transfers, and automated tools to help you grow your money. Some fintech accounts now offer APYs above 5%, though rates can fluctuate more than traditional accounts. These accounts may include tools like roundup savings, budgeting integrations, and even access to early payments. For instance, you could automatically save spare change from every purchase, all while earning a high interest rate. That's money you might never notice saving, but it grows steadily over time. The drawback is variability. Fintech rates can change monthly, and not all accounts replace full-service banking. Still, if you want the highest yields paired with technology-driven convenience. Finally, number 1. Hybrid high-interest savings and cash management accounts. These accounts combine the best of all worlds: top-tier interest rates, FDIC insurance, no fees, modern cash management features. They often distribute deposits across multiple banks to maximize insurance coverage while maintaining liquidity. The APYs in these accounts can reach 5% or higher consistently. You also get instant access to funds, high-quality apps, and automated money management tools. For example, $50,000 deposited in a 5% hybrid account could earn $2,500 in interest in 1 year. Over 3 years, with compounding, you're looking at more than $7,500 in risk-free growth. These accounts are designed for savers who want maximum return without compromising safety or accessibility. They are particularly useful for building emergency funds, saving for large expenses, or just making your idle cash work harder. Here's a quick summary. Convenience. Traditional banks, community and trust. Credit unions, balanced growth with safety. Online banks, maximum yield with tech integration. Fintech cash accounts. Best overall, hybrid high-interest savings and cash management accounts. Before opening any account, avoid common mistakes. Don't chase teaser rates that drop after a few months. Check withdrawal limits carefully. Confirm FDIC or NCUA insurance. Avoid leaving large balances in low-interest accounts. Even small differences in interest rates compound over time. For example, $25,000 in a 1% account earns $250 in a year. The same money in a 5% account earns $1,250. That's $1,000 more without doing any extra work. If your savings account earns under 2%, charges fees, or hasn't been reviewed recently, it's time to take action. Your money should be working as hard as you do. High-interest savings accounts aren't just about earning more. They're about building a safety net, achieving financial goals, and creating stress-free passive growth. Even if you're only saving a few $1,000s, the right account can make a noticeable difference over time. In 2026, there's no excuse for letting your money sit idle. Interest rates are higher than they've been in years, and opportunities to earn risk-free returns abound. Take the time to review your options. Compare rates, fees, and account features carefully. Even a small switch could add hundreds or thousands of dollars to your balance over the next few years. Remember, your financial decisions today directly affect your future security and freedom. The earlier you start optimizing your savings, the more you benefit from compounding interest and smart account selection. If this video helped you, hit the like button to support the channel. Comment below which savings account you're using right now, and subscribe for more actionable money strategies that actually help you grow your wealth. Your future self will thank you for making smart choices today.